Okay, I'm going to explain how to account for inventory when you do not use the specific identification method. So our example here, we're going to be purchasing tires, and we're going to be purchasing these in an inflationary period, meaning the price of the tires will go up over time. Now, when we sell, we do not know which tires we sold because we do not specifically identify them. From an operational standpoint, it doesn't matter which tires I sold. But from an accounting standpoint, I'm going to have to assign a cost for the tires. It could either be the oldest price or the newest price. But according to the consistency principle, I will have to be consistent no matter which one I choose. The methods to assign costs are called FIFO, which means first in, first out, LIFO, which means last in, first out, and average cost. Now, when we say first in, we just mean the first ones we purchase or the oldest purchase. And when we say first out, it just means the oldest ones we're going to expense first. LIFO means last in, which means the most recently purchased items. And then average cost is just going to be a weighted average of all the items in our inventory. So let's see how this is going to work. On January 1st, I bought 15 tires at $50 each. So that would be $750. On January, this should be 15th, I purchased 100 tires at $60 each for a total purchase price of $6,000. So let's see how this works for accounting purposes. So let's look at the first in, first out method, which is what most companies use here in the United States. So let's say that we sell a tire for $100, and let's say we sold the tire that was the first in. The price would be $50. That's the first tire that I purchased. And therefore, my gross profit would be $50, $100 minus 50. Now, if I were to use LIFO, then I'm going to use the cost for my last in tire. That means $60. So I would still sell it for $100, but the cost of the tire would be the last in cost. And my gross profit would be 100 minus 60, which would be $40. And then my last method is called the average cost method, and what this is a calculation of the weighted average. So we purchased 15 tires at $50 and we purchased 100 tires at $60. So more tires were purchased at the $60 amount. So what we have to do is calculate a weighted average. So what we will do is we will take the total, the 750 plus the 750 plus the 6,000, and then we would divide that. So divide that by the total quantities, which is 115. By using the totals that are already multiplied out, that allows us to calculate the weighted average, which we will round this to the nearest dollar. So that would be $59 for the weighted average. And then if we multiply that, 115 times the 59, then the total cost, notice it is the same as if you were adding up the total cost here. Also notice the unit price, $59 for the average cost, is closer to $60. And the reason is that we have so much more at $60 than we do at $50. So it makes sense for the weighted average to be almost $60. So when we put this in, the cost of merchandise sold would be $59, which is the weighted average we just calculated. And then our gross profit would be $41, $100 minus our cost of merchandise sold, $59. So these are the three ways we can value our inventory. Now when you go to work a problem, and you'll see this in the other videos that I made, you will have an inventory table that you can use that will be very helpful when using the different cost methods. And I will show you how to use that table in a separate video.